market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the Republican-led U.S. House has passed legislation aimed at ending President Donald Trump's tariffs on Canada. The vote signals growing anxiety over the White House's economic agenda before midterm elections, focused heavily on affordability. Now, Trump is almost certain to veto any bill calling for a repeal of tariffs. For more, we're joined by Brendan Murray, who leads Bloomberg's trade coverage. Brendan, the man who never sleeps, how much of a blow was the vote to Trump's political agenda, and what does this setback actually mean?
Well, one of the hallmarks of President Trump's past year in office is his ability to keep a unified front and keep the Republicans on side to go along with his tariff policies throughout some turbulent several months there. But what we saw in Washington late yesterday was some cracks starting to form in that united front. I think it's worth remembering also that this vote was focused on Canada, and so certainly there are some states where there is a lot of U.S. trade with Canada, and so American public opinion toward Canada is a lot different than it would be if this vote were against the tariffs on Chinese imports. So you don't want to read too much into this, that this is some kind of sweeping rebuke of the tariff policy, but it's the beginning and perhaps a turning point. If the economy doesn't start to heat up from here, we could see more and more votes like this and more Republicans defecting and voting against Trump's tariffs.
Does this mean any tariff relief for Canada, Brendan? And what might this mean actually for the North American trade deal known as USMCA?
Right. So the message here from Canada, from the U.S. Congress was maybe we should ease up a bit on Canada. President Trump has really picked on the U.S.'s neighbor to the north. He's gone after Bombardier. He's gone down the aircraft maker. He's targeted this bridge that's about to open. And so he's really kind of focused his frustration on Canada at the moment, and the message from the U.S. Congress is, maybe we shouldn't go so hard with tariffs on Canada, a close trading partner, and certainly one where there's a lot of support among especially the northern states for good relations with Canada.
Brendan, thank you so much. Brendan Murray there, who leads Bloomberg's trade coverage. Now, a strong U.S. employment report caught investors in the $30 trillion Treasury bond market off guard, sending yields surging as traders lowered their expectations for Fed interest rate cuts this year. Now, the Sell Now, Ask Questions Later trade sank real estate service stocks as investors rotate out of companies vulnerable to AI. So to walk us through what's happening at the macro and micro level, we're joined by our senior markets strategist, Neil Campling, and Beata, of course, head of European equity strategy at Citi. Beata, thanks so much for joining us. Neil, we come to you every day because every day there's something else actually that we worry about in terms of business strategy or business model. So what did we learn this week and who's next?
Well, that is the trillion-dollar question in many respects. So if we take the example yesterday with these commercial real estate stocks that were hit hard, there wasn't a new agentic AI model that was released. It was more the perception of there could be a model that's released and that could impact this particular sector. So we've moved away from previously the actual models being released and seeing the companies affected to now the potential for models being released. We're definitely seeing we saw indiscriminate selling last week of all software stocks. This week we started to see some of the software infrastructure companies actually rebounding because they own the data. So there is some sort of awareness now that not all should be treated the same. I think I was talking to a very experienced tech investor yesterday, and he was explaining to me that what we have to understand is that with these new models, they are now focused on very specific tasks. Yeah. So we can't assume that the cloud models we had in the past can be used in these models. It's like trying to use a Toyota Prius to run an F1 race. You need to have a very...
My heart. Toyota Prius, an F1.
But it's not an F1 Ferrari, is it? So that's the problem. You need to build the models that produce the fastest, most accurate results and prediction in the future. And I think there's an awareness now in terms of trying to value these companies that there are, a lot of companies that will lose from this race, but there are a few specific winners.
I mean, Beata, this is the concern, I guess. This is not really about valuations. This is about business models, right? It's nobody really wants to be Kodak. I'm sorry about Kodak, but the point is that we don't really know how much disruption there is.
Absolutely. So it seems that the market is trying to figure out all the losers in the space of 2 weeks. Every day, another identified supposed loser, right? But as New has mentioned, there will be nuance. The market is just selling everybody in the same sector, but proprietary data is key, of course. And we've been arguing that this year is the year of bullish stock market, but a very volatile stock market, and the volatility would be induced by the AI trade, which is evolving. So right now we are concentrating on losers. We don't know what the terminal value of these companies is. We know that they've come down a lot, but is it enough? It's really quite unknown right now. But also what we need to discover what the new winners are going to be, right? So adoption, and very effective adoption this year is key, and this is one of our main themes for the year.
So, Beata, you think this week was challenging, and I don't know whether, again, because of these quick rotations, I mean, it is sometimes difficult just to catch your breath, actually, from one day to the other. So are you expecting this kind of intensity to continue? Underlying fundamental, like European reporting season was also not bad.
Absolutely. So there are a few things here. First of all, the reaction to the reporting season. Okay, not great, but all right reporting season. And we are seeing very disproportionate price reaction to these reports, right? So when you miss, forget about it, you get punished a lot. But actually, on average, if you beat expectations, average price reaction in Europe, at least, has been negative. It doesn't happen very often, right? So this is one. That's to do with the markets being very rich. You've mentioned it isn't about the valuations. Of course, for the individual stocks, it is about the terminal value and how disrupted they can be. But for the overall stock market, it is a stock market price for perfection and over-delivery. That's been the case with the US for some time. Now, actually, perhaps with the exception of the emerging markets, Europe is also one of these markets that is priced for perfection and over-delivery. So you need to really over-deliver a lot to get it in. And then the weird thing is, of course, is how calm the index level is, and you have these crazy moves underneath the surface. So what we notice is...
What is it, dislocation? Like broken correlation?
It is ferocious rotation and huge dispersion. So dispersion has been climbing already, and in Europe is the highest since the global financial crisis. It has been higher in the TMT bubble build-out. And then, so that actually, it's not necessarily a bad thing for stock pickers. It tells you that there are opportunities, right, if you are on the right side. But as the rotation happens, you need to be very nimble and change all the time. And on the other side, you have very low correlations, so stocks are not moving together. The difference between the two, the gap, is the lowest since it's been only lower in 1999 and 2000. The same can be said about instead of correlations, you could use volatility of the index level. Very high, not as high as the gap between the other two, but historically, when we looked at the forward performance from these levels of gap between dispersion and volatility, at best, you're flat over 1 to 3 months. Yeah. Over 6 months, market up. But in the near term, it tells you that this volatility or a bit of anxiousness in the market could continue.
I mean, a curiosity, Neil, I guess, is like how much of this is market, angst because too much was priced in. I mean, I don't believe a lot of the big sell-offs that we've seen in software. I mean, the CEOs will be on top of this. All we talk about is AI disruption. Yep. So are there any steps that they can take to not go, not to have their business model shattered?
Well, I mean, it depends on whether you have a moat, whether you have a real business moat or not. And to Beata's point as well, you talked about terminal values. This is the discovery process taking place today, I think probably in both public and private markets, because a lot of these deals, if you like, in terms of private equity deals in software, as well as the public companies, we are now starting to question the terminal values. Yep. We're now starting to have to adjust the calculations for the DCFs And that's where you get the markdowns. But that's also where, if we look at previous tech cycles, the likes of a company like an Oracle, for example, was being disrupted by someone like Salesforce. But what Oracle actually did is it took advantage of the depressed valuations to buy JD Edwards, to buy PeopleSoft. It built up a huge arsenal of companies under its hood because it had that structure and it could buy in the cash flows. I suspect the next wave we will see is actually a wave of M&A from the leaders buying some of the other companies that they can then sort of improve margins and improve their moat around their offering.
Beata, I mean, going back to like reporting, repricing, rotation, is there anything that looks more or less attractive after the week that was?
That's an interesting point. And of course, in this rotation, everybody is piling into outside of tech stocks, and we have rotation into mid caps away from large caps. Actually, when we look at valuation after last week and we look at forward PEs versus where they are trading percentile-wise in the last 25 years history, in the US, one of the most attractive sectors right now is tech. Right. Software is a big part of that cheapness, but it does look the most attractive. So value, where everybody's rotating into, actually looks more expensive now than growth. So that's something to contemplate on. Outside the US, it's still the opposite. Value is much cheaper versus its own history than growth, right? So
time will tell.
Yes.
As always. Very quickly on, I mean, in terms of AI in Europe, is there anything that you're looking at specifically?
So, of course, AI, in like the first phase of AI that we've gone through, hyperscalers, the build out of data centers, Europe didn't, outside a few individual companies, didn't have too much to offer or participate. However, if indeed this is the year of the market demanding evidence that this big capex spend is going to yield some returns via, well, labor productivity gains, for example, this is where Europe can really kick in and could be very interesting. So physical AI, broader set of sectors applying it and seeing some gains.
Is there a name?
Siemens Energy is a good example, and Siemens numbers today, record highs in the stock. You have to have the pipes, you have to have the infrastructure to enable AI in the first place. So there are infrastructure ways of playing the AI trend across the globe, and Europe's included.
Okay, thank you both for a great conversation for this Thursday. Neil Campling, our senior market strategist, and Beata Manthey, head of European equity strategy at Citi. Now, coming up, the UK's largest standalone asset manager is being bought for nearly £10 billion. We have the details next, and this is Bloomberg. That matter, the insights you need. This is the Pulse, and I'm Francine Lacqua here in London. Now, Nuveen is buying Schroders in a £10 billion deal, creating one of the world's largest active asset managers with nearly $2.5 trillion of assets. Well, speaking exclusively to Bloomberg, Richard Oldfield, the Schroders chief executive, said the deal will give the company more firepower.
What we are doing here is creating this powerhouse of asset and wealth active management. It's going to have an unparalleled breadth of public to private capabilities. And at 2.5 trillion, it gives us the firepower to actually invest in our business and make ourselves more relevant to clients.
Let's bring in Tom Metcalf, our managing editor for finance in the EMEA region. Tom, firepower, I mean, how critical is this for actually an active manager?
Oh, it's absolutely essential. So it's all about scale, right? And Schroders, long time, been one of those where they've clearly been needing to, address that. I think that the shock here is just how quickly it's happened since Bruno Schroeder died. The family's always been, a hallmark of its independence. So I think in the sort of halls of Schroders, people are kind of waking up this morning going, did not see this coming, because total shock to the city.
2.5 trillion. I mean, again, we're a bit blasé. Where does that rank?
Oh, as an active manager now, it's definitely one of the big players. So the largest is something called Capital Group, a very low profile, but has about 3 trillion. So it's basically top rank. But then, of course, you want to compare that to the BlackRocks, the Vanguard. BlackRock has 14 trillion, and that's just a sign of why active managers. There's all these pressures on them. Lower fees, all that stuff, which is why they need to. Schroders was not that small, but it really needs to be, top tier in the industry to survive.
Tom, how big of a loss is this for London, for the UK, and the City of London?
Yeah, I think it's certainly an emotional one. Actually, it's kind of a real link back to the old City of London. Schroders, probably along with Rothschild, one of the last hallmarks of that. I think really pragmatically, something like this had to happen. But I think there'll be a lot of probably quite sad people actually, because it's a real institution, and whatever happens, moving out of family ownership, American owners effectively, something's going to change. Whatever the CEO was just saying about, this is fantastic. I imagine a lot of people are quite nervous today.
Yeah, I know we'll continue, of course, some of our great reporting in this, Tom. As always, thanks so much, Tom Metcalf, our managing editor for finance in the EMEA region. Now, oil climbing for a second day as traders remain concerned about U.S.-Iran tensions with the potential for military strikes and risks to supply oil. With us now, Nadia Martin-Wiggen, director of Svelland Capital. Nadia, thank you so much for joining us. I mean, every day we talk about crude, and the sentiment, because it all ties back to geopolitics. But what are you seeing in terms of refining and where the oil price goes next?
Well, we actually see a very strong market for refining. We see that runs in January were up 2 million barrels per day versus expectations in December. And we saw that the U.S. increased runs year on year by 1 million barrels per day, despite the fact that we had all that cold weather. So I think in that regard, the market has been much too bearish in terms of expectations, and inventories are still low.
So is there a glut? Again, I've never seen a market where actually there's two narratives that seem to be really competing and no one can get on the same page.
Well, I'd say the glut narrative has definitely been the dominant one, and that is really continued since the second half of 2024. But what we see now is that really the inventories haven't built. The IEA report this morning, it only shows a 3.9 million barrel build in December. OPEC was showing 6.5 million barrels. And yet the IEA is talking about a 3 million barrel per day build last year. In supply versus demand, they expect the call on OPEC to be 600,000 barrels per day lower this quarter than last quarter, and for that to continue. And I just can't find the oil.
But so how do you read that? Is it a problem with the economy, that there's just not enough consumption? Is it Russian oil that's sitting somewhere?
Well, I think the demand is actually higher than they're capturing, first of all. There is inventory, of course, building in China in particular, that we expect to continue at least through the first half of this year, if not the next year. Geopolitics are a part of that. I think on Russia, we're finally really seeing a logistical problem. So when War 2.0 started, the IEA was saying we could lose millions of barrels per day of oil. That didn't happen. Now we could increasingly start to lose from 100,000 barrels per day up to 600,000 barrels per day because of logistical problems. It's not a production problem, but it's where to put this sanctioned oil that isn't getting bought. And
so this is not basically the U.S. telling India, look, if you want a trade deal, don't buy Russian oil.
Well, it is a part of it. I mean, in that we already see a pullback of around 500,000 barrels per day. There's still more than 1 million they could buy. But also China's taking almost all they can of Russian oil at this price. They want an even steeper discount. And of course, they're not taking Venezuelan so much anymore because it's expensive. So I think they're putting that pressure, and that will resume a bit. But we do see that it's tricky. The dark fleet has to continue rising for Russia to keep able to produce.
What's China doing? Are they still building stock?
Yes. And in our view, easily they could build 1 million barrels per day this year. If we think about Xi and his address, we could see something happen in Taiwan next year. They are preparing. They're not only buying oil, they're also, we see that there's a pull to the east to own tankers. We even see stockpiling a bit on the metal side in China, and that's in preparation in our view.
So if you think, this is what, like an invasion of Taiwan, a takeover of Taiwan? What happens to the price of oil if that happens?
Well, then I think it would go higher because that is that demand pull. We get more of this kind of splintering off of the world. And even if they were not going to invade Taiwan, I think they want to be prepared because we're in such a divided world. So everyone needs to have their resources in line. And we see that being led by the U.S.
Iran and then gold. Iran, again, we're on tenterhooks. Is there going to be a strike or not? And there's a huge danger for the Strait of Hermes. But what does it mean if there was a strike, let's say it's a surgical strike from the U.S. to get rid of the leadership? What does that do to the price of oil?
Well, it depends. Well, First of all, it's bullish. I think what we saw with Venezuela, though, the U.S. focused on blockading the oil. So one thing is the closing of the Strait of Hermes by the Iranians, which, we're on the fence if they would actually do that because it's so bad for them. But on the other hand, the U.S. could control shipments going out, and they could control Iranian crude, which is the focus, not the rest of the crude coming out of the Middle East. And that's what we saw with Venezuela. So I think that shows things. What we saw also with Venezuela, Maduro's out, not a complete change. In Iran, it's very difficult to see who would replace the government. The way I like to think of it is they've never been weaker, the government right now, but who is going to step in? And that's where I think it's complicated. So more strikes rather than a complete regime change, I think, in the near term to start.
Gold.
Yes.
So is this just a pure play against U.S. assets?
Well, I think it is about nervousness in the world. And this started with central banks. We had Russia buying before they invaded Ukraine. Then we had the Central and Eastern European central banks being the huge buyers since the invasion of Ukraine 2.0. We saw LatAm coming back into the market end of last year. Oh, Venezuela happened. Suddenly they were buying again. And then the big new player is really Tether, with their stable coins and their U.S. and their gold coin. And that's the last 2 quarters of last year. They were the biggest buyers in the market. And that's diversifying away from just having a U.S. Treasury-backed cryptocurrency, which is what the governments around the world are doing. And, then we have discussions of ADNOC issuing a bond in won. And that is just indicating that we're going to diversify our centers of universe and our supply chains.
But so gold goes higher? I mean, we saw quite a big violent pullback, actually.
Yeah.
Was that a blip?
Well, no, I think part of that was driven by silver. I think we saw a big jump in ETF buying at the end of last year in December, especially in Asia. And that's more nervous money that kept buying. But the long-term buyers are there, and we expect to break through the previous highs this year, no problem.
And then it just keeps on going higher? I mean, is there a 3-year target that we need to be looking at?
Oh, I mean, it's a lot of geopolitics in the world, changing trade patterns and so forth. But, I mean, we definitely think $6,000 is a target, and then we just see.
Nadia, this is a difficult question, but could you see, if something happened with Taiwan or even Iran, could you see gold actually moving more than oil because it's almost like an asset worry, a worry asset?
Yeah, and it's also a trade concern, right? Yeah. So that absolutely, and what we've seen so far is it's been moving so much more than oil. Oil has been stuck in this range bound, but I think the market is understanding how much this short, bearish, negative narrative on oil for the last year and a half has actually pushed out a lot of interest out of oil. And once they start to see that this market is actually getting tighter, then we'll see a lot of flow coming into that oil side to push up prices.
Nadia, thank you so much for joining us. Nadia Martin, Wiggen, Director of Svelland Capital. Coming up, we'll delve into the world of peer-to-peer luxury fashion with the Chief Executive of the clothing rental app By Rotation. That's coming up next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Schroders succumbs. The storied London company agrees to a £10 billion takeover by Nuveen of the US, creating one of the world's largest active asset managers. Donald Trump's trade policies face their biggest political challenge to date as 6 House Republicans break ranks to vote against his levies on Canadian imports. Plus, traders bet on fewer Fed cuts this year after a strong U.S. jobs report, payrolls rising by the most in more than a year. So traders have lowered their expectations for Fed rate cuts this year after strong employment data. Let's bring in Ven Ram, Bloomberg Markets Live cross-asset strategist. Ven, I'm going to ask you about correlations. I'm going to ask you about rotations. But first, is this kind of jobs report good news for traders, even if it gives the Fed a little bit more room to stay put?
Morning, Francine. I think, yes, it is good news for traders, particularly for equity traders, because it means that, the jobs market is doing fine. The U.S. economy is roaring. So, and the Fed is going to be in a situation where they want to be cutting rates, even though perhaps they shouldn't be cutting rates. So that's the bowl is fully flowing over. The punch bowl is fully overflowing for equity traders. But if you look at treasuries, Francine, I think there's a message there. If you look at the 2-year yields, we haven't meaningfully come off 350, and we keep coming back to that level. Since September, we have bounced, we have not able to go below that level. And if you look at the long-term 10-year yields and above, they are also not coming off 420 levels. So there's a message in for the Fed there that even if you cut rates, the markets are going to be increasingly skeptical whether yield should accompany them lower together.
Then the dollar's reaction to payrolls, a little bit anemic. So, this quiet quitting, how should we look at tomorrow's CPI?
Well, I think that, the dollar is moving a bit away from the data, if you will, Francine. But I think there is a bit of risk premium. There's considerable risk premium priced into the dollar. That's to the tune of 4% and more. And that's down to erratic policy making and also the fear of investors that the U.S. administration wants a weaker dollar, despite all that they say outwardly, particularly because President Trump said so explicitly last month. And we are also heading into the midterm elections. So there's a fair bit of skepticism. Dollar shorts are building. So I don't think there's a good atmosphere to be constructive on the dollar.
Okay, Ven, thanks so much. As always, Ven Ram, their Bloomberg Markets Live cross-asset strategist. Now, onto a bit of fashion, a bit of luxury. Hermes sales grew on robust demand for its coveted Birkin bags. The French bag maker is one of the industry's most resilient players, chalking up gains across all of its markets and most of its products. Well, for more, we're joined by Deborah Aitken, senior analyst at Bloomberg Intelligence. So what are we to make? I feel like they can't do any wrong, Deborah. It's a bag maker. It's like the luxury company that everybody wants to be or wants to own.
Absolutely, a totally unique model, so true. But, one of the things, so we saw 10% growth, the market's struggling in the first quarter. We saw that growth move from 7% in 1Q to 10% in the fourth quarter, a solid outlook for next year. But when we think about we always label to Birkin bag, but actually their leather goods is 45% of the business now versus 55% a few years ago. It's only on limited number of designs, but then it's doing really well in ready-to-wear, in home, in jewellery, back to growth in second half in watches as well. So you're right. So compared to so many of the peers, you could label it in that way.
If you look at the PE valuation, right?
Yeah.
It's just also really strong.
Yeah.
They haven't put prices up by as much as some of the others.
So they always put the prices up in the way that manages their cost base. So actually, in the for 2026, they say 5 to 6%, which will still be quite robust versus probably 3 to 4% elsewhere. And that's on the back of their artisans, the new products to market, their production sites, and others. But also, these companies in France are facing big corporation taxes again into the second year with that surcharge, high currency exposure, and then you have the US tariff as well. They can manage that, and what separates them really, aside that top line, is very much the fact that they grew gross margin, operating margin, beat consensus, and they run their EPS in line with reported revenue growth last year, 2025.
Deborah, we love talking luxury on this program, and it always also often comes back to look where there's too many luxury products. There's maybe too many luxury companies, but also we're going to have a good conversation with the founder of Buy Rotation about secondhand. This is peer-to-peer lending, but actually, are you seeing more of a resurgence of secondhand, and does that mean that people are buying less?
You would think, if I look at social media, there's a lot more, for example, Hermes and Louis Vuitton, because Louis Vuitton is much higher volume. There's a lot more around, and there are those who wish to have real heritage, something that is 20 years old plus, which is craved for, and also with Christian Dior's and others, Chanel. However, it is high end, and then there's the mid end, which doesn't really hold the price so well. Yeah. So, for Hermes, you're waiting in a queue often still for the product, so it is a way to own prior to where you would be in the queue. Yeah. And so the Hermes CEO would say he's not bothered by that, it opens up the brand to the mid-market type of thing. But he's doing that from a lower volume. And I think there is, for used, for pre-loved, for second-hand, a way forward for all of this industry, because we are getting growing middle classes. And that is helping, with some of that demand to be swept up in that area.
So interesting. Deborah, thank you so much. Deborah Aitken, they're a senior analyst at Bloomberg Intelligence. Now, if the typical Hermes bag is out of reach, but you'd still like to raid the wardrobes of style icons like Dame Helen Mirren or Ellie Goulding, you may have come across By Rotation. Often described as the Airbnb of designer fashion, this peer-to-peer platform offers a red carpet look at a fraction of the cost, or helps you build a side hustle by monetizing your own wardrobe. Well, By Rotation's founder, Eshita Kabra-Davies, is with me now. Eshita, thank you so much for joining us. I remember speaking, almost when you launched actually By Rotation. And again, the idea is that if I have a wedding or just have a big event, I can rent from someone, someone else, and then rent it for a couple of days. Like, are you surprised by the kind of growth you've had?
Yeah, and I think the interesting thing is that we started off with a pretty low average order value, where it was more about contemporary clothing, which Deborah just spoke about, and now you can rent things like a very rare Hermes Anemone Kelly Puchette bag on the app. So it's really become much more about rare, vintage luxury and access rather than ownership.
Yeah, and it's amazing how actually I do feel, especially for the younger generation, there is a little bit of a shift. It's a lot of them say, well, I don't need to own it, but I'd like to wear it for social media. Or, I mean, is it different, depending on the age of your customers, on what they want to buy and where?
Certainly. I mean, we've obviously categorized our customers. You've got some who are renting for things like graduation, some who are renting for holidays and weddings, and then you've got some who are actually trying to rent and try items before they actually invest in buying them. So, I recently rented this Chanel bag, which is worth over £9,000. It's from 2019, so you can't even buy it anymore. And I rented it for £150 for a week, had lots of fun with it, and then I realized it's not something I would actually buy. So it's something that you can use even to try before you invest in that piece. And we talk a lot about investment because we are seeing fashion as an alternative asset class of its own. So you can rent out your pieces and make more than £200,000 on the By Rotation app, and that's in addition to your full-time job.
That's really quite impressive. You're also announcing a strategic partnership with Uber, and this is, again, it just goes back to people want things pretty fast.
Yeah, and we're talking about fast fashion, but not as in fast, low-quality fashion. We're talking about fashion on demand. This beats a lot of luxury e-com retailers who can only do next-day delivery, whereas with our partnership with Uber, you could rent something that's in your neighborhood because you can find out what is around you at the moment on the app, and essentially send an Uber courier, as we have a partnership with them, and get it within the hour.
Eshita, I mean, we talk to a lot of entrepreneurs to try and figure out what you think the funding environment is like. Is it tough being in the UK at the moment? Is there demand? Do you have enough funding? Is the government helping?
Yeah, I mean, we are very lucky that I believe we are the winners in the UK when it comes to rental and peer-to-peer. We really position ourselves more as a tech company, so more of the sharing economy, and we have partnered with the likes of Uber and Airbnb. For us, there is a lot of growth potential in the US, where we launched a couple of years ago, and we're also looking at the UAE. So for me, while UK is very much our headquarters and we're very proudly British, we dress Lady Starmer, for example, we are very much a global company with global ambitions, much like myself as a private citizen.
Is there more? I mean, is there more? I guess is there more rivalry, or do you have more fierce competitors in the UAE or the US?
I would say probably in the US, because in the UAE, secondhand, they're still kind of coming to terms with it. I'm from Singapore myself, and there is a big stigma around secondhand. But I think attitudes and the way that they look at secondhand will eventually change. The US is more rife for it, I think. You've obviously got the tariffs, which make secondhand much more attractive. You've also got access to European goods, again, the Hermes, the Diors, and you can get them secondhand by renting them, forget even buying them. So the amount that you're spending to rent these items, for a week is like 3% versus buying them secondhand for 70%.
Eshita, when you look at the UK, is there anything that the government who could help actually entrepreneurs like yourself?
I think, continue to support and champion, especially investments into female-founded businesses. I think there's a lot of lip service around that. There's a lot of mentoring programs. I have said before at the UN as well that women don't need mentorship. We need funding. So stop telling us about all these programs and actually put your dollars where your mouth is, or whatever that saying is.
Is there enough capital going into female-founded companies?
Not enough. Never enough. There could definitely be more. And I think on the consumer side as well, especially since we position ourselves as a social network, a lot of the social networks are all born in the US. There seems to be no winner in the UK and Europe, which is such a shame because there's so much culture here.
If you were to start the company now, would you do anything differently?
I don't think so. I love peer-to-peer, and actually, very interestingly, we are the business model that has survived and, been through the trials and tribulations. If you look at quite a lot of the other players out there within rental, they're very inventory-based. They're very heavy on their CapEx and OpEx, sorry. And I think what's really interesting for us is that we are transforming how fashion is consumed altogether by unlocking a third of your wardrobe that's just sitting there and not doing anything. It's really an asset class.
Eshita, thank you so much for joining us. And, check out Buy Rotation. Eshita Kabra-Davies, founder of Buy Rotation. How much growth are you expecting?
We're expecting 3x.
There you go, 3x. Now, on to another corporate news, and Siemens has raised its outlook on growing demand for data centers and its factory automation products. Now, the German industrial company benefiting from its move into industrial software and artificial intelligence solutions. The chief executive has it speaking to Bloomberg's Tom McKenzie.
We will see how dynamic, how fast AI is hitting really the real world. We believe that this happens very fast. But from that perspective, we see still there's a good growth. There might be shortages on power supply or supply maybe on GPUs. But since the supply chain is also ramping up, we believe that this keeps on going.
And you think that the CapEx spend, the commitments from those hyperscalers, $650 billion US potentially this year, that is rational?
I mean, I didn't make the math of all the commitment which everybody gave, including the investment banks. Adding that up, there might be a slippage, but if you take even a slippage into consideration, still enough money for a market to keep on going.
And you've got a record backlog now. About 120 billion euros is the backlog. What are the constraints around delivering that backlog? Are you able to deliver on those orders?
Clear, yes. I mean, we really invested early enough. So we doubled our manufacturing capacity for medium low voltage in the United States, exactly for data centers. We increased capacity for rolling stock. By the way, big backlog comes also for rolling stock. So we have capacity. We invested in capacity. Also in capacity for our automation devices. So that's not a problem. We will deliver.
There is a currency impact. How and to what extent is FX impacting you, particularly euro strength, and how are you looking to mitigate that? Are you taking any hedging strategies around the currency?
I mean, we always do some hedging in the background. The impact, I think, is something like 50 basis points, and we planned the fiscal year on this weak dollar, and so therefore that's part of our planning. If that stays in that ballpark as we see today, that's part of our forecast and our planning.
Okay. You talk about the software part of the business. We've seen a significant sell-off, including industrial software names, in the last couple of days. What do you make of what we've seen there? How defensible is industrial software from the evolution of AI and some of these products being put out into the market now?
So we know that AI has the potential to disrupt some of the software businesses. I mean, if you talk about software which runs on call centers and the like, I mean, that's fully on the block. But if you go on the other end, on industrial software, simulation software, physics-based software, we don't see that at all. We rather see an enrichment of the software, which allows more and more customers to use it. Take, for example, simulation. Simulation is costly, takes a lot of time. Using GPUs, we can accelerate it 100 or even 1,000 times, making it accessible. Yet, The point is that you always want to frame it with the physics, because hallucination is not an option on the shop floor, neither in your designs. And this is where physics comes in. It always gives you a confinement of what really is right and wrong.
That was Roland Busch, the chief executive of Siemens. Now, Verisure shares slumping today after the security services company reported fourth quarter earnings that missed estimates. Verisure's shares fell below their IPO price for the first time last week after being caught up in the AI disruption sell-off. Now, the chief executive has been speaking to Bloomberg about the impact of the technology.
We're obviously actually an AI beneficiary. We're going to demonstrate that progressively over time. We're already using AI to great benefit in many aspects of the business. And if I take maybe the core of what we do, which is the security service that we provide, I mean, it's basically what we call detect, verify, intervene. Yep. We're actually using AI algorithms already to do a better job of analysing incidents, right, of confirming whether it's, in a sense, a false positive or real. And we think we do that better than anyone else.
Coming up, normally on the same page, but maybe not right now. President Trump hosts the Israeli Prime Minister in the White House. We have the details on what the visit means for Iran. That's next, and this is Bloomberg. Nuveen is buying Schroders in a £10 billion deal, creating one of the world's largest active asset managers with nearly $2.5 trillion of assets. Speaking exclusively to Bloomberg, Richard Oldfield, the chief executive of Schroders, says the deal will make the company into a powerhouse.
Well, Guy, I'm going to take us back a second. So there were two announcements this morning. The first one was our results, and it's important as context to the deal. Our operating profit was up 25% to 757 million. EPS is up 39%. This is a great business. It's in a really strong foundation. But what we are doing here is creating this powerhouse of asset and wealth active management. It's going to have an unparalleled breadth of public to private capabilities. And at 2.5 trillion, it gives us the firepower to actually invest in our business and make ourselves more relevant to clients. It's a business combination that's almost perfect on paper. We have total complementarity. There's no overlap in geographies, really. There's very little overlap in products. So we're about growth. We're not about taking money out of the system. We actually drive this business and create something really powerful. And the cultures fit, the heritage, the 300 years together. So it's not just, you mentioned our two centuries of history. Nuveen comes with more than 100 years of history as well, and that actually helps us have very similar cultures. And as you mentioned, Guy, this is all about the City of London. We put that right at the heart of the deal, making commitments to the UK and London.
Richard, did they call you? Did you call them? Where did the conversation start? How did it go? Kind of just give me a bit of colour here.
Well, as you'd expect of the last year, I've been talking to many of my peers around the world about how they respond to the industry challenges that we've got. And what became clear as I met Bill is that we had businesses that were very similar, and we discussed the complementarity. And that led to them approaching us with an offer earlier in this year.
Richard, good morning to you. So you mentioned there that this is about having the firepower to invest. Would it be right to say that AI has changed the landscape and the requirement to invest in that technology to find that an opportunity rather than a threat means that it's better done with a larger business? Is that one of the drivers?
Well, that's definitely one of the drivers, because the scale of this operation will be able to create more capacity to invest in our business. And it's not just about AI. Actually, when you think about our industry, it's about tokenization and distributed ledger technology. It's about reshaping our industry, about different distribution models. And yes, it's about AI in terms of how we do research, how we do portfolio construction, how we access wealth clients. So I think there's a whole range of technologies here that are going to transform our industry as other industries. And we need to be right at the forefront of that change.
You talked about making commitments around the City of London, Richard, and we read in our stories this morning that the London is going to be the headquarters of the non-US business. What do those commitments look like, though? How watertight are they?
well. They're all listed in the 2.7 offering document, and I think Nuveen have been pretty clear. London will be the non-US headquarters for at least 5 years. There are commitments about jobs over the subsequent 2-year period. We'll have about, to put this in context for you, Anna, there's 3,100 people in the combined group right here in London, and that's the largest location of any office for Nuveen, and it would be about a third of the overall workforce. So this is a big, sizable presence here in London. We're not stepping back at all from our commitment to support the UK capital markets, be at the centre of how policies are formulated, be at the centre of how people come to market. So I think the commitments are very watertight and they're very real, and I think it just shows the size of the UK and London in the overall group.
Well, that was Richard Oldfield, the chief executive of Schroders, speaking exclusively to Bloomberg. Now, U.S. President Donald Trump says he intends to press ahead on talks with Iran, despite reservations from the Israeli prime minister who was in the White House yesterday. Let's bring in Ethan Broner, our Israel bureau chief in Tel Aviv. Ethan, thank you for joining us. So President Trump and Netanyahu normally aligned in their worldview, but will Netanyahu be disappointed this time?
Well, I think you're right that in this particular case, the president is more eager for a deal. The Israelis really don't believe that it's worth negotiating with Iran, that this is a regime that is uncompromising and will not step down from its anti-Israel, anti-Western ideology. So I would say that the Israelis were certainly Netanyahu was certainly somewhat disappointed, but, you know, we have to wait and see. There's another carrier group possibly on the way into the region. And, you know, there are several issues the Israelis want the Americans to press Iran on. I think that President Trump is aware that a quick military activity is unlikely to take down this regime, and he doesn't like long engagements. He wants quick, decisive action, and I think he's hoping that a deal will get further in that direction than a strike. So we'll see. There is tension, it would seem, between the two over this.
Ethan, also the agenda, Trump's so-called Board of Peace. So what was discussed?
You know, I mean, the big issue for the Israelis is disarming Hamas. And so far, there's no evidence of anyone able to disarm Hamas except for the Israelis, or if they go back to war, to do so. The Americans say they have a plan in which Hamas will disarm voluntarily, and perhaps the arms will be held somewhere in storage. Everyone is pretty skeptical of this. I think we have to see where this goes. But it does feel like, to be on this particular issue more than on Iran, that the Americans are willing to see the Israelis go back in, if necessary, at least on a short-term basis, if nothing else works. At least that's what's being held up as a threat, in the same way that these carrier groups are being held up as a threat. It's very hard to sort out, you know, the theater of it from the reality of it, and my guess is that the leaders themselves aren't quite sure the difference at the moment.
But Ethan, what does each party want from each other?
You mean between the United States and Israel?
Yeah, and Israel. Mm-hmm.
Oh, I mean, the Israelis want, of course, no daylight between them and the United States. They want the United States to agree that the future of this region is only secure if the regime in Iran is ultimately taken down or forced out, enough pressure is put on it for it to go. That's certainly what they want. The Americans, I think, have more belief in diplomacy. They also seem to think that this government shouldn't last, but it's not clear to me how much they want to invest in taking it down.
Ethan, thank you so much. Ethan Broner there, Bloomberg's Israel bureau chief in Tel Aviv. Now, The Pulse is live from the Munich Security Conference tomorrow. We'll be joined by big guests, including the executive director of the Aspen Strategy Group and the vice chair of PIMCO. Up next is Bloomberg Brief, and this is Bloomberg.